Are you genuinely able to spot a correct market maker buy or sell model? Now, if you're also chronically online and on Twitter all the time, you have probably seen God knows how many pictures of this exact thing right here. Now, if you read those threads, this is called MMXM or a market maker model. Now, in this video, I really want to show you guys not just how to spot this as just a pattern, but actually how to trade it and where your targets are going to be with this exact model. So if you don't know, I do live trade every single day. I trade PO3s and the market maker model. So if you do want to live trade that with me for completely free for a week and literally steal my entire strategy with a full video course and get access to tons of traders who have gotten 5-6 figures in payouts, then click the first swap link down below. But without further ado, let's kind of get into it. So just kind of going to delete this stuff here just so we can go back over it. So essentially within a market maker model, we are always going to have our buy side curve and then our sell side curve. All right. Now, if you just go around on any time frame all around the market, you can spot these literally everywhere. Like here is a clear market maker model right here. Even here's one right here, etc. You get the point. So like all things with ICT, essentially with PD arrays and things like that, you can spot a market maker model on any time frame, and you can actually use it for not just your entries, but for your bias as well. Okay, now essentially when you are starting to build your buy side curve, the way we are actually flipping into a sell side curve and seeing a reversal is called a smart money reversal. Okay, so we have a period of accumulation, and this doesn't have to be a PO3, but most of the time, not most of the time, but a decent amount of the time, it is a PO3, which we see right here. We have an accumulation period, a manipulation period, and distribution. Okay, now a market maker model pretty much explains the concept that the market cannot just, go straight up and straight down, right? We have to create these accumulation periods and sometimes these little manipulations. Now, what these accumulation periods actually are is it's pretty much just engineering liquidity, okay? Now, we are engineering all this liquidity right here, these lows, to eventually be taken out, okay? Now, when you see the PO3, that means you are likely in one of these consolidation periods and you are about to break out of it, okay? Now, within a market maker model, once you have your reversal, obviously you're not just gonna go in blind trading the buy side curve. I mean, you might have some other confluences or another strategy to trade this, but usually we're not even trading the smart money reversal either. Majority of the time, we are trading this first reaccumulation leg. And that first reaccumulation leg, essentially, majority of the time, it's going to be during New York because New York session typically has the highest volume. So whatever that most recent fair value gap is, or that kind of whole displacement leg, we will tap back into that and actually respect it. Okay. And in this scenario, you can see that reaccumulation period was actually a PO3, right? And when did this move start? The PO3? 15 down there, I'm on UTC, but that's 10 a.m. Eastern. That's when we actually trade the PO3. So that's when that started. As you can see, I'm on the 4-hour time frame, but obviously, if you're on the 4-hour time frame, this is something you're going to use for bias, 4-hour, daily, weekly, and hourly. Those are all kind of bias time frames. Execution time frames, you're typically wanting to trade around like a 15-minute to 5-minute market maker model. Okay. Now, anyone can go and spot market maker models. Obviously, like I said earlier, oh, it's just a sell side curve and a buy side curve, or it's a buy side curve and a sell side curve. Looks pretty simple. If you just look for it that way, you're pretty much essentially just pattern trading. Okay. Anyone can spot a loop down and a loop up. You're essentially just looking at like a cup and handle at that point. So there are a couple of key ways that you can actually trade the market maker model and tell when these accumulation periods are going to be over and when to actually enter your trades and what to actually target. So when we are flipping, okay, we had our smart money reversal, and keep in mind, I do want to mention this first. So not in this scenario because obviously this is an all-time high scenario, but did hit a standard deviation, but that's besides the point. Majority of the time, when you are looking for a smart money reversal for one curve to turn into the next, you want to see price tap into a high time frame PD array, whether that be a 4-hour daily, weekly order block, whether that be a fair value gap, whether that be a breaker, etc. You want it to tap into a high time frame PD array. Obviously, at all-time highs, that's a different scenario. We are simply just in too deep of a premium and hit some standard deviations. But so back to it, I want you guys to really think about liquidity when you're trading market maker models. That's essentially what it is. And the main topic at hand here is going to be IRL to ERL and ERL to IRL. Now, I don't know if I don't think I've made an in-depth YouTube video on this, but essentially what IRL is internal range liquidity, external ERL, external range liquidity. Okay. Now, your internal range liquidity is going to be your internal fair value gaps, okay? These are essentially just inside, right? This is all of your internal ranged liquidity right here. All right, now your external range liquidity is going to be these more prominent highs and lows. So again, this is external, this is external. This is definitely going to be external right here. And eventually once this reverses, that will be external. Okay, so external high, high time frame highs. Now, essentially, the way the market moves is it will find some internal range liquidity. Once it reacts off that internal, it will go and seek out external range liquidity. Okay? So, for example, as we can see just in this buy side curve here, we create some internal range liquidity. We end up tapping into that internal range liquidity and seeking external. Okay, so like in this market maker model right here, let's go on bar replay and just check this one out. Okay, we can see we formed external range liquidity over here. Okay, now we want to hit internal range liquidity before targeting that. So boom, internal, then we target the external. Now, in general, with market maker models, you are going to want to trade the reactions off of that internal ranged liquidity. Okay, so reactions off of those fair value gaps. Now, majority of the time, those are going to be your PO3s. Okay, so like we see right here, we have our accumulation. We manipulate into this internal ranged liquidity. Okay, we are reacting off of that. Okay, we saw a clear reaction. What's our next target here? It's going to be that external range liquidity that we just formed. Okay. Now, in a scenario like this, when you are flipped, you already have built up the buy side curve and you're looking for the sell side curve. Okay. Where's our first low risk entry going to be? It's not going to be the smart money reversal. It's going to be our first touch of internal liquidity right here. Okay. We get that touch of internal liquidity. We can zoom in and see that, boom, we get a change in state delivery back to the downside right there. That's where we can short that market again. Okay. Now, back to the 4-hour real quick. What's going to be our next target here? We hit internal range liquidity. We're going to target external range liquidity right down here. So hit internal. Where's the nearest external? Right down here. So that is where you're going to let that ride. Now, any kind of internal range lows that have been formed from the first curve is also where you're going to want to take profits. So this low right here from this PO3 is a very good point to take profits, as you can see. But again, same thing right here, internal to external. And this is how market maker models tie into PO3s, okay? It's really just all ERL to IRL, IRL to ERL, okay? So boom, we form an external high up here. What do? We target internal liquidity. What happens after that? We go back and target that external. Okay, so this is kind of just a brief rundown of market maker models and internal range liquidity with external range liquidity. Let's try and find another example of a good market maker model. Let's drop to the 15-minute here. Don't want to do today because today was pretty terrible price action. And yeah, again, market maker models are never going to be like complete picture perfect for you, right? And that's why I say don't think of it as trading a pattern. Think of it as just purely finding liquidity. So right here, we made an external high. We had our selling climax here, and we made our sell side curve, okay? Not a picture perfect reaccumulation period, but what happens here? Whoa, I meant to draw that. We sweep out some high time frame liquidity right there and see a reversal, okay? Now, where's that first lower risk entry going to be? It's going to be a tap of some internal liquidity, okay? So we saw our reversal. What do we see right here? I believe this is actually a 2 p.m. 4-hour PO3 as well. Let's turn on our 4-hour candle. Let me see. Oh no, that's where we opened. Yeah, so this actually is a 2 p.m. PO3 as well, which just shows how this can be very time-based. These expansion periods will typically start during New York, so you'll see that manipulation and you'll be able to get your entry during New York. Majority of the time, you're also going to get that expansion. But again, right here, we can see accumulation, manipulation. We tapped into that internal 15-minute gap and respected it, and then boom, change in state delivery right there. Also ties in with our time-based PO3. This is a point where I would go long. Now, I tapped into internal. What's going to be my next target? Again, I do not care about these. I'm only going to care about my external highs because I just hit internal. Now I'm looking for external. And we have kind of some relative equal highs over here. So those are going to be great targets. So I want to ride it all the way up to that. And we can see that play out. Little slow, but we eventually get to where we want to go here. There we go. Boom, took out all of those. And starts ripping. So this in a market maker model is typically going to be the entry you want to see, okay? After your smart money reversal occurs, this is the most frequent thing I trade within a market maker model, is this first reaccumulation period, okay? That first reaccumulation period, it's going to tap into a 15-minute fair value gap, and you're going to see a reaction back up. And if you don't see those, then it's not going to be your low-risk entry, okay? You need to see a retest of a fair value gap within that first reaccumulation period, okay? Now, also, within here, let's look at this one. As you can see, market maker models are everywhere. They are a very important concept to understand. So we have our sell side curve here. What's the bottom of that sell side curve? This external low. So this external low is going to be our final drawn liquidity. So there we have accumulation period, another PO3 accumulation period, and then we have our reversal up there, okay? So what's going to be our first low risk entry? It's going to be this right here, that FAG retracement, which if you can see on the hourly, what do? Smart money reversal right here. We form an hourly fair value gap right there. We tap into that, and then you can see we expand lower. And what are we expanding lower to? Again, these external lows. Now, again, like I said, when you are trading a market maker model, these lows that you put in from the first curve are also excellent take profit points. Okay, so let's say obviously you're not going to get your entry on the hourly. Say you get your entry somewhere around there, like 120 tick stop, right? Perfect TP1, 1.81 there. Set your stops to break even, trim there, and take the rest off here. Boom. As you can see, that expands pretty aggressively. But yeah, just wanted to tell you guys kind of about the importance of ERL to IRL when you are trading market maker models. Again, you can't just look at it as a pattern. Like right here, you cannot really just be like, oh, we had a selling climax and now we're starting to push back up. Now's my time to enter. Oh, right here, look at this. We finally got a market structure shift above these highs right here. Now I'm going to go long. You go long off the market structure shift and you get stopped out because you didn't wait for internal to get tapped into. Always wait for internal to get tapped into, okay? Now, in scenarios like this, where we're clearly flipping, again, boom, we tap into internal right there. What do? We get our first market structure shift. What do? We form internal. We tap into internal, and then we go higher. Now, this is actually a great example right here. I'm going to show you guys how this entry right here ties into the 10 a.m. PO3, okay? So again, step one, we have our sell side curve right here, okay? Here is the top of that selling climax. That is ultimately going to be our final draw on liquidity. Do we have some other highs within here? Yeah, we have a decent one right here we can take profits at. Not really one right there. So pretty much 2 points where we can take profits, this being our long-term draw on liquidity. All right. Now let's bring it back all the way to here. All right. So I know that we are flipping into a buy side curve because we just got our market structure shift, right? Now I'm going to wait for a 4-hour PO3. So in this scenario, I see the market has ran, there's probably like over 600 ticks here. I see the market has ran almost 800 ticks at market open before we even had our macro. What does that tell me? We're going for a long accumulation PO3 setup, okay? And the market maker model is also on the hourly, so makes sense to do that. Now, the long accumulation PO3 at 10 a.m. means we will accumulate for an hour to form that internal range liquidity on the hourly time frame instead of just on the 15-minute or the 5-minute. So you'll be able to see that opens and we consolidate for about an hour before pushing up because we are trying to form that hourly fair value gap. Let's go back down here. What do? Boom, form an hourly fair value gap. After that market structure shift, we're going to mark out that internal, and boom, we tap into it instantly. So this would be your entry right here, and this is like an excellent swing position, right? Right here. Where's our most recent? So, I mean, if you wanted to snipe it, you literally could, and I think we took this trade. Yeah, we did take this trade. So boom, inverse fair value gap right there. If you want to wait for a CISD, you can. But now that we have hit that internal range liquidity on the hourly, again, what am I going to target? I'm going to target that final draw on liquidity, which flip back to the hourly time frame, our external high. Okay. Boom. Flip to buy side curve, market structure shift. What did we do? We formed internal range liquidity. We tapped into it. Now that we tapped into internal, we're going to go back and target that external range liquidity. Okay? Which is all the way up here. Okay? So literally, obviously, you're probably not going to catch a 27 risk to reward, but this was pretty much an A+ swing trade. So yeah, perfect setup there. Again, smart money reversals, it's great if they are a PO3. It's not going to happen every single time that cleanly. Essentially, what you want to look for is a selling climax turning into a bullish market structure shift, wait for internal to hit, and then catch that trade. Now, these reaccumulation periods right here and right here, those are like scenarios where you can add to the position, or even like right here. All right. I usually like to catch that first one. If we're lucky, we can snipe the smart money reversal, but like I said, it's not going to be as clean as that first reaccumulation leg always is. And again, right here, another example. This one's a little bit quicker, but what do we do? Here's our smart money reversal. What do? We form internal range liquidity right here. Boom, tap into that. IFEG signaling we are ready to continue down. Short there. Stop at that high. Where's my external? Right there, the bottom of the buying climax. So that's where I'm going to short to. So again, I'm hoping some of you are going into this video already having a basic kind of grasp of what the market maker model is, because I didn't necessarily go all the way start to finish. This is more for you guys that are just sort of looking at it as like a pattern. This is actually how you trade it. You can't just wait for, oh, sideways movement, I'm going to enter here and catch the longs up there, or I'm going to wait for this to hit. No, you need to be trading this and thinking about liquidity while you do it. So I hope you guys got some good value out of this. Again, if you do want to watch me live trade and steal my entire strategy, and there's a full course video on this that's like 20 minutes long that goes way more in depth, then click the first link down below. If you're more interested in sort of a one-on-one mentorship with some group sessions and a way bigger course, then click the second link. I only have a couple spots left. But yeah, hopefully we'll see a couple more of you guys in the free trial, and don't be scared to reach out to me with any questions. Again, I hope this cleared some things up about how to actually know when to enter within the market maker buy model. But yeah, let me know if you guys have any questions in the comments or video ideas you want to see, and I'll see you guys in the Discord.